Hi, everybody. Welcome to the 7 and 7 show with Zack Ellison. Today I have with me Dr. Eddie Sanchez from the University of Florida. Eddie, thanks for joining.
Great. Thanks for having me, Zach.
So Eddie's got an incredible background in tech investing, and it goes back 20 years or so for some large institutions and hedge funds. So Eddie, tell us how you started out and how you got to University of Florida.
Yeah, great, Zach. Great. Thanks for having me. First and foremost, hello, everyone. Kind of give you a little history of my background. It's kind of unique because I was a computer science major back in the 80s when, yeah, they did have mini and microcomputers and they did have mainframes. But I got my kind of hands wet when I was in, an undergraduate student at Quinnipiac College. I was working at a hospital in Hartford, Connecticut, and I got a chance to understand, mid-frames and mainframes, operating systems, networking, storage, semiconductors. I got a lay of the land because I was a computer operator when I was at school. I was a computer science major when I was at Quinnipiac, and on weekends, I would work I'm trying to remember the name of the hospital, but I think it was Mount Sinai Hospital, and I was the computer operator on Saturdays and Sundays. So I really got a chance to get hands-on understanding, different types of hardware, different software, networking, operating systems on the machines. So as I was going through school, I got not only the practical experience of getting my hands kind of, dirty, but I also got the theory and understanding whether it was programming, system analysis, and things of that nature. And the courses that I took, databases was another course. So some of the things, and I remember also learning BI, which I will kind of triangulate. And BI is business intelligence, and I'll try to triangulate a little business intelligence to artificial intelligence, the word being intelligence. Anyhow, when I graduated, I went to work at EDS as a systems engineer. I quickly found out that I didn't want to move to Houston for my second rotation, so I joined the Travelers Group. I got into what's called an accelerated entry into management, and it's a 5-year program where they would move you around the company. This company was the Travelers Insurance in Hartford, and I was in different roles as an IT information technology person. So I got a chance to do programming, system analysis, work on databases. So those are the type of jobs that I had. In my last rotation, I did one in corporate finance. And what I was looking at in corporate finance was I was looking at all the IT systems that would produce the information to the CFO so the CFO could deliver the earnings. And at that point, Travelers had 5 different businesses. A couple that I remember were healthcare, property casualty, life insurance, trying to remember auto. So these are the different types of businesses that Travelers had. And I needed to basically bring all the systems together so they could feed, into corporate finance and into the area where the numbers were basically tallied so they could deliver the earnings for Travelers. So the beauty of that job was I got a chance to rotate around many of the businesses at Travelers, and I got to experience different type of either databases, software, hardware, doing different types of analysis. So I really had what I would classify as a strong foundation, not only from academia, college, but working while I was in college, and now I'm doing it at the next level. Anyway, in my last rotation, I quickly decided that I was also working on my master's in economics at Trinity College. I wanted to make a transition from doing system analysis, programming to the world of finance. So I made this really big jump, Zach. I mean, really big, where I moved into being I would classify myself probably as a short-term bond trader. I was hired out of the program by a gentleman named Mark Wiles, Sandy Wiles' son, who was the CEO of Travelers and ultimately Citigroup. And Mark was the chief investment officer at the Travelers. And he gave me a job. I wanted to be a portfolio manager, and he actually put me on the short-term money market desk. And that was a fun job because I got my first taste of really understanding an organization like the Travelers, and understanding kind of the risk spectrum from short-term money markets, which is really short-term bonds, short-term debt that we could invest in, like commercial paper, overnight treasuries, 1-week treasuries, longer term treasuries in the standpoint we were all buying treasury bills 6 months, 9 months. So I was doing basically managing the working capital of a company like the Travelers. So I had a very big portfolio. I had a $2 billion portfolio. And this is my first foray into the world of investments and understanding a balance sheet of a company, right? I didn't look at the income statement. All I was doing was really managing the cash at the Travelers and putting that cash to work in what? Investing in short-term maturities, trying to get or receive basically some interest on that short-term money, the working capital of the Travelers. So I did that for about 2 years, and I really got an understanding of the bond markets. I got an understanding how the bond markets work from the short term all the way up to 30-year bonds. I really got a lay of the land of understanding interest rates and how interest rates affect, investments. And I'll also talk about that. But I did that for 2 years, and then I was able to advantage of the opportunity of a lifetime, where there was a gentleman who was running a small cap portfolio, was looking to hire a technology analyst. And I had no background. I had a computer science degree, did some corporate finance work. I had a master's, and now I'm making this jump into trying to become a tech analyst for, $1 billion small cap. And I never forget some of the stock pitches that I made back then. I pitched Cisco, and I pitched, let me see, I'm trying to remember the company that Amazon, Whole Foods. And these were companies that had very, very expensive multiples to their earnings. And my boss was a value guy, always looking for very low PE names, catalysts for maybe a change in the asset structure that could change the business model where their value could be created. So that was what I was headed into. And I never forget, I started working for Harvey Eisen was his name. I started work for Harvey in 1997. And I never forget trying to pitch him all these high growth names, and he wanted no part of it. And so I quickly figured out that if I look at some of these beaten up names and figure out if I can look at the balance sheet, find some value there, that I can get him to put some of my recommendations in the portfolio. Anyways, fast forward a little bit, Harvey left, and my coworker, Jack Eisenstadt, and I were able to make a pitch to Mark Weil to start a technology fund within the Travelers. And we started the fund in 1998. And for the young people who haven't been around, 1998 was a tough year in the markets because long-term capital, a fund with some of the most intelligent Nobel laureates, investors at this hedge fund basically collapsed. But Jack and I, who's my coworker, we had started the fund in January, and where my capabilities really came through was understanding technology. And we'll get a chance to talk about what that means as an investor. And I never forget Peter Lynch always saying, understand, and Peter Lynch was a great manager at Fidelity, understand the company you're buying. If you want to you want to have ownership of Coca-Cola, understand that they're selling soft drinks, or Walmart, right? Or Amazon today, right? Understand. I had a great understanding of the technology landscape. I knew about software. I knew about hardware. I knew about storage. So this gave me what I would classify as a competitive advantage over some of my colleagues who were investors on Wall Street, because I really understood technology. And technology can get people to want to pay exorbitant multiples, right? Because they're buying more of the hype and less of what the technology is doing and how that technology transforms a company selling technology, how they're able to turn that into a business model that's generating future cash flows for whom? For the equity holders of a company. So anyways, I did that. I was an analyst, moved into portfolio manager. Jack and I had a great year. I remember we were up, I think, 20% the year when the market was down, 1998. 1999 was a tremendous year because of the internet boom, right? So you had all these companies and all these stocks, kind of a little bit like today, but it's a little different here because we got large cap. But everybody was trying, I say everybody, investors were trying to figure out these internet companies. And we had this build out in technology and in telcos, right? And I remember we had companies basically doing what they do today, right? Was outsourcing the hardware basics and bringing people on and companies on to provide the services. So all this money was being not only invested in some infrastructure for the technology for the internet, but it was also being invested in some of these companies that will never, ever make a dime. And the one thing I always, and I think, and I go back, I never forget analysts pitching and recommending companies to investors where all the company would do was just shoot web pages up to people, right? But how does that translate into the business model of that company, right? Making money. So anyhow, I was an analyst, not only in the portfolio, but I was a portfolio manager. Jack and I ran the portfolio for about 3 years. Our returns were astronomical. We were up 20, 180, 120 something, I think, that year. And then even in 2000, the market kind of collapsed off of the internet. We still were up another 20 or 30%. So, and I attribute all that to my capabilities of understanding business models and basically understanding the technology that is associated with and finding great companies. So that's my background at Citi. I later started a hedge fund. I found it very, very difficult moving from Citi and being able to manage money without having the Citigroup, I call umbrella in the name. But I did that for a couple of years. I was successful doing it, but I decided I wanted to go to a larger hedge fund. So I went to one of the biggest technology hedge funds, not the biggest on Wall Street, the Galleon Group. I did a lot of software investing at the Galleon Group as an analyst, and I also was a PM. I did that for about a year, off and on. I've also run money. I ran money, actually, for a private company in New York. And the best thing about that was the payouts were really, really good when you made money. And I was pretty successful only because I had a strong background in technology, understanding the better technology plays versus the companies that I thought would never make it because of their business models. So fast forward kind of through my years, I moved because of family reasons. I met my wife. I moved to the Midwest. I still manage money for some New York-based company. I did that off and on. I decided when I was in the Midwest, actually in Kansas, I was asked to go and speak to some portfolio management classes at the University of Kansas. And the reason I'm telling the story is because this is my foray into academia. You know, I was also working on a master's and an MBA at Creighton because I had an economics degree, but I wanted to get a finance degree. So I got a master's in finance because I thought I needed it to teach finance courses out of college. I didn't really need them, but I did anyways. So not only did I have this, I would call a really strong background in investing as an analyst, portfolio manager, hedge fund manager, where you buy long securities, you go short. So I did that, but I was also building up my skills in the academic side. And then I really made a jump where I decided to go to the University of Florida and get my doctorate in business administration. And that was probably one of the hardest things. You know, my wife said to me when I joined and started to do my work there, it's like, you just want to go from the frying pan to the fire. But it's interesting. And I never forget my dissertation chair saying, Eddie, why did you want to do your doctorate? And I said, because I wanted to really do a better dive on research. So Wall Street produces research, okay? I would say in some cases good, in some cases very bad. Academia, maybe that's the same classification, but I felt I wanted to strengthen up my skill there. So anyhow, I completed my doctorate at University of Florida. I went down to the University of South Florida. I taught there for 4 years. My claim to fame is I did win Professor of the Year, so students probably loved me because I did a great job. And I think what I bring to the classroom is I can bridge the theory and what takes place, what you read in a book, with my practical experience on Wall Street. And my practical experience really stems from from credit, looking at bonds into equity. So I've seen a pretty good spectrum of different types of securities. And now, recently, I'm a clinical professor at the University of Florida. I'm doing 2 things. I'm teaching a valuation class, and I'm also working with some very, very bright students. We're trying to build one of the few, if not 1 or 2, long-short equity funds at the university. So that's where I am today.
That's amazing. So before we dig into all that, let's talk a little bit about the University of Florida's program.
Yeah.
That's how we met. So I'm in the program as well, and I'm about 75% done with the classes. And we now have a lot of professors in common that we both learned from. And now you've got an office right next to them, and it's great how that's worked for you. I think I'm going to wind up doing my dissertation with Michael Reingart, who sits, I think, in the office next to yours.
Basically, yep. Mm-hmm.
So what's great is Michael did his PhD at University of Chicago in the 80s. I'm pretty sure he did his his work under Eugene Fama, if I'm not mistaken. I have to double check that.
He
So
did.
we've
Yeah.
got nice.
George French too. So the farmer. Yeah. So he had some pretty. He had a strong dissertation committee.
So I'm trying to keep that lineage going because we've got the University of Chicago connection where I did my MBA, and now we'll have the University of Florida connection. And you had some great advisors too. You had Andy Naranjo, if I'm not mistaken.
Yeah. So Dr. Andy Naranjo was my mentor, and I never forget when I was looking at doctoral programs. Andy's involved in very many things, but he's, I think, the director of the International Center, and he has a class on international for the Masters in International Business. So he takes them on trips. And he was on a trip in Brazil. And I remember sending him an email saying, hey, I've got this weird background. I'm a hedge fund manager, and I'm thinking of doing a doctorate. What do you think? He goes, you need to come here. We're doing a lot of research on hedge funds, and you'd be a great asset to the department and to some of the professors who can use some of your practical knowledge. Yes.
So what attracted you to the University of Florida's program versus other schools?
Yeah, Zach. What attracted me was the faculty. So I had a faculty member at Creighton who was my econometrics professor, and I spoke with her about what I was thinking for my second career. And I said, listen, this is what I'm trying to do. I'm trying to really, build up my research skills. So she said, go out, do the due diligence like we do on companies, and go find schools that may have a program that's attractive for you. And so I looked at some programs that seemed to be more like executive MBAs, but they were doctorate of business administration. Florida had everything. The more important thing I think that Florida had, being a great school, I think in a large part comes from having great professors. And if you look at the professors across the disciplines at Florida and in the business school that would have been my professors, the backgrounds were very, very, very strong. I.e., either an Andy Naranjo or Mike Reingart. I have a great relationship with Dr. Jay Ritter, who they call Mr. IPO. He was done a lot of research in IPOs, and he's on CNBC all the time and talking about IPOs. You got Mark Flannery and Chris James, both of them great in the banking sector. So a lot of firepower, a lot of brain power around different areas of finance, and I wanted to be a part of that in some form or fashion. When I was there, I spent when I was doing my DBA, it was more of a weekend program, but I turned it kind of into a PhD, where I spent a lot of time with many of the professors going to seminars, presentations, and understanding the research. So I really put in the groundwork to get myself to where I am today, in getting myself to become a professor in the Department of Finance, because they've got a great department with great professors. And I would say to myself, I think I did a good job getting into that.
Yeah, I agree with you. I think it's the best program of its kind in the country. And I did a ton of research before choosing University of Florida. And one thing I'll mention is my education was at some very good schools, but they were all Division III athletic schools. So I started out in college in 2000 at Swarthmore College, which at the time was actually the #1 liberal arts college in the country, according to the U.S. News and World Report. I didn't know what it was in high school, and they wanted me to play basketball there, and I looked it up and I thought, wow, this is a great opportunity because they're #1, so why don't I go there? So that's how I started out at Swarthmore, and then later I did the MBA at University of Chicago, which is Division III, terrible sports program, generally speaking. Great academics, of course, but and they've been ranked #1 business school and #1 finance, pretty much unequivocally. And then I did another master's while working full time at NYU.
Yeah.
So I did an MS in risk management at Stern. And so those are great schools. I thought the professors at each school were tremendous. I thought my classmates were tremendous at each school. And I wanted to find something that was equivalent or stronger. And that's pretty hard to do when you've been to 3 of the best schools in the world. And what I really liked about Florida, to your point, was the professors are incredibly strong, and the institution itself is the flagship of the entire state of Florida, and really, in my opinion, the best school in the Southeast United States.
Yeah, I would equivocally agree with you there. I totally agree with you there. And one thing, that you're mentioning when you talk about the professors, the students in the class are tremendous. There's a vast background of different experiences, where it's either Bain Consulting or, being CFOs at these companies. So it's not only the professor, but it's also your classmates are excellent.
I think that was my biggest surprise. The upside was how great my classmates were. I expected them to be, talented, of course, but the bond that we have in our class is very strong. I mean, I've never been in a more helpful group of people, probably in my entire life. And there's about 25 of us, and we're from all over the country. I think the average age is mid 40s. We've got people as old as in their mid 60s, and some, I think the youngest is in her late 20s, and everybody's just phenomenal. So that's been a huge bonus. And then, of course, the alumni network also is incredibly powerful. There's 500,000 alumni from the University of Florida, 500,000 plus. 300,000 live in the state of Florida. So a lot of people have questioned, not a lot, but a few people have said, well, why are you doing a doctorate? Why do you need that? And I said, I don't need it. I'm already successful. I'm doing it because I want to be the best. And if I want to be the best in what I'm doing in venture debt, I need to have access to the Southeast market of the United States, which I think is the best growth region going forward. And the best place to connect with folks is University of Florida. I can get a meeting with anybody in the Southeast United States by saying, go Gators, I can make you money. And I get in the room. And that ultimately is tremendous.
It speaks volumes, I think. It really does, from Florida. And it gives you the ability to be able to go into either a family office or talking to investors, basically with your pedigree and your background, to be able to say, listen, I have done it on the academic side, but I've also done it in the world of Wall Street. Yes.
I mean, I'm learning a lot from you and the path that you traveled, because you did quite well on Wall Street for many years and then decided you don't need to work anymore. You do this because you enjoy it and you want to give back and you love learning and you love the community. And that's ultimately what I want to do one day as well. I've probably got another 10 or 15 years left in me before I reach that stage, at least, because I love what I do. So I might do this till I'm 85 years old. Who knows?
Right. Yeah. You know what? The great thing about being a teacher, not having to manage money, is I don't have days like today.
Yeah, right. I know it is nice. As former traders, we both know what it's like to wear risk 24/7, even on the weekends, because the market's going to change and you're going to come in Monday morning and you're going to have, oftentimes a firestorm to put out.
Exactly. Yeah, it's a good point.
So I want to dig into this investment program that you're building at the University of Florida, because I think it's an amazing program, but I want to learn more about it and have people learn more about it.
Yeah. So Florida, right, has a couple of, funds that students can participate in. So as undergraduates, there's a founders fund where they take students who want to learn the skills of being an analyst and ultimately becoming a portfolio manager. And what they do is they make pitches on companies and they pitch them as longs. So to give you an example, in the Founders Fund, they don't actually manage any money, but they have like a quasi paper portfolio where they say, you know what, I want to pitch Coca-Cola or pitch Apple or pitch Amazon as a long in the portfolio. And what they're doing is they're acquiring the skills of an analyst on Wall Street, right? And we'll talk about that in a second, what those skills really are. And then you've got the Gator Student Investment Fund, which is a fund for students. Most of the students in that fund are working to get their master's. It's a 4-year program at Florida called Masters in Finance. And many of the students there are working to get their master's, so that it's a different level of student, number one. And they do have $1 million capital that they're investing in. And what they're investing is, there's 13 sectors in the S&P, and they've got sector analysts within those sectors, and they got portfolio managers. They're basically pitching stocks and putting them in the portfolio. And they have, hands-on live money where they can put that to work. What I'm trying to do is take my capabilities, my background, and maybe build a fund that's maybe a little more from the standpoint of, I wouldn't say risk, but from a standpoint of actual work as an analyst, riskier, because I'm looking at doing a long-short equity fund where, as an example, let's say, call it a hedge fund, I want to go long Pepsi, short Coca-Cola, right? So first and foremost, what is shorting? Shorting, you believe that the company fundamentals are going to deteriorate, I can go out to the market, sell the stock, right? Borrow it, sell it, and with the hopes that if I sold the stock at $100, it would go down in price to $50, and I would make the difference between 150 because I would short the stock. Why would the stock go from 150? Maybe because the company is going through a business cycle transition, or maybe because the fundamentals are getting worse because of the economy. So there are many reasons why we short stocks. Number one. Number two, we could also hedge a portfolio. Why would we want to hedge a portfolio? Well, because we don't want to take any market risk. So to give you an example, right, Zach, I'm long Pepsi because I like the business prospects and their future cash flows. I can buy that stock and I can short Coca-Cola and I can put those two in my portfolio as a hedge. So if the market went up and down, don't care. All I care about is that when the stock appreciates, I want Coca-Cola to appreciate more in value. Sorry, Pepsi-Cola than Coca-Cola. And when the stock goes down or the market goes down, I want Coca-Cola to go down.
So let's pause for a sec just to dive into that for folks listening. So oftentimes that's called a pair trade. And what you're really thinking about there is the relative value or relative performance between those two companies.
Exactly.
Yeah.
Mm-hmm. So that's what we're looking at. And what we're really trying to do is we're trying to take the risk, right, out of the market, right? So that to me is good analytical work, right? I'm not betting on a stock because the market's going to take it higher. I'm betting on a stock because of the true fundamental. How do you come up with intrinsic value of a company and fundamentals? You're looking at the future cash flows. And what you're betting, if you're going to make a bet outside of just investing in the S&P 500, is you think, right, that the intrinsic value of the company should be what? Worth more than where the market is saying it is. If not, you would just buy the market. So you would be doing that, and then you would be hedging it or a pair trade with a stock that you thought had deteriorating fundamentals. And in this case, we will be looking at two companies that look very, very familiar.
Yes. So Eddie, how do you think about the intrinsic value versus the perception of that company, which leads to the price? So in other words, when prices don't match up with intrinsic value because they're either too high in a very bullish market or maybe too low in a bearish market, how do you think about that? Because there's that risk when you're short that the market sentiment could be very strong and take a company with mediocre fundamentals and still keep pushing the price higher.
Right. And that's a great question. So, and this is the things that I'm teaching my analysts, right? At the end of the day, the only way that I could value a company is by looking at its prospects on its future cash. I can't come in every day and judge sentiment. I can try to understand it. I can try to understand what's taking place in the market, but I can't basically make my investment decisions on what the market is doing, right? I got to make my investment decisions on what the business model suggests these cash flows are going to look like, number one, and what are the probability of those cash flows, right? And if I have strong probabilities that those cash flows are going to be, very strong, that the company's going to have super growth, and that's not being reflected in the stock price of a company, I'm going to try to take advantage of that, okay? But that comes from, number one, understanding the company and its products, and then assessing the probabilities of those future cash flows. And how do I determine value? Well, if I'm going to grow basically the cash flows going forward, what is the probability of, let's say, for example, the Apple growing 50%? Probably not a very high probability. But the market may be pricing it that way. So my job is to figure out that the market may be wrong there, to figure out why is it wrong or where my analysis is wrong in those future cash flows. And then to also appropriately discount those cash flows at some sort of risk. For instance, rates are rising now. There's greater risk in future cash flows. Why? Because as rates rise, that causes the cost of capital to rise for companies, and that ultimately will probably cause a slowdown in the company's business prospect. And tying this back to the Student Management Investment Fund, these are the skills that I'm trying to build for my students, help them build those type of skills, where they get away from the company and these rising stock prices, and they get more into understanding what is the value. Because ultimately, over the long term, stocks will reflect what their cash flows are going forward from that point in time. The internet boom of 1999, very many companies weren't making any money. So the entire prospect was on these growing sales, but how do those sales turn into, right, something profitable and in return for whom? the shareholders, the investors who gave them the money. Okay. So I try to get away from, and I always have gotten away from the hype, the euphoria in the market when the market's going up. And I don't get too down when the market's going down as well, like in 2008. I'm always looking for opportunities. What I try to do is develop a process. And my process always comes back to the business fundamental. And there's one saying that you will hear many analysts say when they either come back or talk to me. One comment Eddie used to always say is the cash flows don't lie. Okay. So I'm always looking for cash flows, strong cash flows at a company. I'm looking for also a return on investment that's greater than the weighted average cost of that capital, because that will bring you value to company.
So Eddie, I like this quote from Ben Graham where he talks about in the short run, the market is a voting machine.
Yes.
In the long run, the market is a weighing machine. And so to your point, what he means is that over the long term, fundamentals will dictate value and price. But in the short term, they don't necessarily. And so one question I have before we dig in to some more fundamental investment principles and processes is when you have a really irrational market, like we had in 21 and still to this day sometimes have in certain pockets, do you avoid certain companies or sectors that just have a lot of hype behind them because they're really not tied to fundamentals in the short term?
Yeah, that's a great question. Zach, it was interesting, right? Amazon has been classified as an expensive stock for the last probably 20 years. And here's understanding the interesting dynamics of the Amazon stock and its valuation. And Amazon's a great company, right? The question is it a great stock? It has been, but it's been an expensive. And I was speaking to a large cap portfolio manager at JP Morgan. And this was his line to me. He said, Eddie, I know that Amazon is very, very expensive, right, to the cash flows. He said, but I have to own that company in my portfolio because if other portfolio managers who are large cap managers own that and that stock continues to rise and I don't own it, my fund is what's going to happen is I'm going to basically have poor performance relative to those other portfolio managers who are owning that large cap stock. That's number one. Number two, as you can see over time, there are very few companies that can be that large and grow that fast. Okay, Tesla's a really good example of that too. Expensive, and you get these large cap growth managers that are looking for these companies, that grow very, very fast, and they're willing to pay prices that don't really make any sense, right? Because these companies could never grow into those valuations. And then another thing I think for the older portfolio managers, I used to hear this, they used to always say, I don't want to get Walmart. And I go, what does that mean? We all miss Walmart because we never believed in it, or Home Depot, and those became great companies. So there's a couple of dynamics there. But how do you kind of capture that in a factor or something? It's very hard. So what I try to do, great question, is stay away from the heavily shorted stocks or stocks that have these multiples. There are plenty of stocks out there with good business models that may be coming through a peak and into a trough, maybe coming out of a trough and into a peak. Plenty, even in technology. And it's interesting because I've even told students, you can find value even in technology, i.e. Meta or Facebook, trading at $76 last year, right? Because they were spending too much money in CapEx. Company changes its CapEx, changes its business model. Meta goes from $76 to $300 today. So there are opportunities in there. What I try to do is figure out where the dislocation is in great companies. Sometimes there is some of that, and also not so great companies, but good companies. And I will also say another thing I think that investors have to understand. If I'm a portfolio manager at a fund and I own a sector and I decide that I want to reduce my weighting of that sector, I could be selling some names that are very, very cheap as a multiple to either cash flows, as a multiple to earnings, at the multiple to sales. And those names are just being sold because the manager just wants to take that money from those names and put them into another sector. So you could have some very good companies that get dislocation in price relative to their intrinsic value, all right, that you say to yourself, wow, there's an opportunity here. Always focused on, as I tell my students, what are the future cash flows, what are the probabilities, and what is the risk. So that's the way I do it. Yes.
Eddie, I want to emphasize one of the key points you made, which is that a great company does not always make a great investment. And a lot of people get this confused, even professionals. I've been on teams. I've worked for 3 different institutions that manage over $1 trillion in assets. And even at those institutions, working with the analyst teams, people continue to make that mistake. They would say, when I was a trader, hey, one of my fundamental analysts might say, hey, I really like this company. I'm like, yeah, it's a great company. That's why it's investment grade, right? That's why it's an A-rated company, but there's no value there. And so I think that's something to really keep in mind, that a lot of professionals, and certainly a lot of younger folks, get wrong, is they think because a company's got great fundamentals, like a Coca-Cola, for instance, that you brought up a couple of times, that it makes a good investment. And oftentimes it doesn't. And conversely, you can find companies that don't have good fundamentals, that are deteriorating, or that are poorly run companies, and you can actually make a lot of money on them if you either short them or you buy them at the right price, where it's low enough such that there's a lot of price appreciation left in them. So I think that's something to
make an interesting point, Zach, because that's a great point, right? I talk about Apple, and I say I never ever tell students in my classroom, I teach a valuation class, or in the fund, short this company or buy this company. I talk about what are the numbers telling me, and I always allow them to decide. Apple is I always say, ridiculous company. Show them the numbers. A company that can generate 180% return on equity, and they can borrow at 3%, and they can take their margins from 38 to 43%, and take their revenues in that same time frame from 280 billion to almost 400 billion. That's a great company. But I say to them, does not always make it a great stock. All right. Another thing I tell them is, look at the price to earnings. Apple can be and is a cyclical company, even though they've gotten into the services business, which has been represented in their business model. It's a more stickier type business. But Apple always traded at a discount in multiple to the S&P 500. And what is the S&P 500, Zach, right? All these 500 companies generating future cash flows. And at the end of the day, why was Apple generating? Why were investors? Why were paying a lower multiple? So the average over the last 100 years, the multiple to earnings for the S&P 500 companies on average is 17 times. Why was Apple trading at 13? Well, because investors feared that cyclicality in the iPhone, right? That would hurt in bad times the earnings. But they've kind of bounced out the business model, number one. Number two, they, in some regard, showed investors, hey, not only we're getting away from some of the cyclicality, but when times are not so good, we can still maintain 43, 44% gross margins when they were 38, and we're doing it on larger numbers, even though our numbers are actually slow, because you know this and I know this, right, Zach? The bigger you get, the harder it is to grow and grow and grow 10 and 20%, right? And when you're doing $400 billion and you're generating $110 billion a year cash flow like Apple is, you can't acquire the entire market. So I think that's very, very important. It's very important for investors to understand is great companies don't necessarily make great stocks.
And there's so many good points you just made. I want to make sure we dig into these. So one is, when it comes to larger companies, you also have trouble as an investor gaining an informational advantage. Whatever you know or I know about Apple, there probably 1,000 other smart analysts know as well. And there's probably things they know that we don't even know. And so it's very hard to make money, in my opinion, as a large cap investor, because you're competing in a market where you don't have any informational asymmetry or informational advantage. And so that's one of the reasons why I transitioned my career out of the public bond markets and public fixed income markets into venture debt, because I have huge informational advantages here. I know things that nobody else on the planet knows, and as do other people in the private markets. And being able to leverage that private information, it allows you to generate alpha and outperformance for prolonged periods. So that's one thing I want to mention.
Yeah, that's an interesting point, because what you're saying is you're using your capabilities to figure out where there's value, right? And is that value represented in the value of the company, i.e. Apple now trades at 28 times? It's probably well represented, right? The information, like I tell my students, every day you wake up, there's hundreds of people looking at Apple stock, right, and looking at the valuation. And by the way, there's a guy in Omaha, right, who's one of the largest shareholders of Apple stock. Okay, trust me, I tell you, he's looking at it. And even at 28 times, he's probably saying to himself, probably pretty expensive relative to the earnings prospects. Why do I say that? Well, I'm paying this multiple that's, 10x, basically 10 times greater than what you would pay for normal S&P 500 for a company that's got slowing growth on the top line. You can see the numbers, and will have slowing, net income going forward. But still, a great company. So that's very, very interesting. So what you're saying is your marginal, right, product is not your capability in buying a large cap, where it is much greater in what, venture cap and areas where the market's not as focused, where in some cases you could make an argument that it helps you and hurts you because you got smarter investors maybe in your market, right, than the traditional, maybe the retail investors that may not know enough about what you know, where they could be funneling money into Apple or Nvidia or Tesla, right, where that's more of a speculative play on their part versus what you're doing in basically financing companies that are different stage in their business cycle.
Yeah, in a way, what we're really talking about here is market efficiency, and it's easier to make money in less efficient markets, and that's something you learn in the first day of business school, really, in investing classes. It's really that you want to go where other people aren't, because if you do what everybody else is doing, by definition, you're going to get an average return, right?
You get an average return if you extend that, right? In a perfectly competitive market, what are profits? They're zero, right? So same way, there's no money to be made, right? There's no arbitrage, right? The arbitrage with you could be the information right? But absolutely a great point. And I will always say this. Remember how I started out my conversation with you is, what are my capabilities? My capabilities are technology. So I felt like I had that upper edge against others when I was evaluating a technology company, because I could make a distinction of why I thought this company was better than that company, and where I thought the numbers were incorrectly being priced, or those cash flows being priced by the market. Because at the end of the day, when Apple opens up, it's trading at, I don't know what it's trading at today, let's call it 170, right? The market's telling you what they think of Apple's future cash flow. The question you have as an investor is, do I buy that stock today, or do I put my money somewhere else, right? And you have to bring that capability. Probably less capability to understand with Apple and their $410 billion sales versus you looking at venture companies and startup in different cycles of the stage of the startup, right? Trying to develop into a company like Apple.